welcome back for Saturday, April 9th of day 9 or way 9 of how to get started in real estate investing. Hope you've been enjoying the videos so far for the month of April. Be sure to hit that subscribe button so you never miss an episode. Now, yesterday's video, we talked a little bit about subleasing, or essentially renting a property for long-term usage and then re-renting or subleasing that for short-term. And that was a nice option in case you do not own the property. You are just basically doing rental arbitrage. Now, here's an option that you probably have thought about, especially if you own a second home, a vacation home, lake home, cabin, condo like I do in Tucson, Arizona, where you can rent that out when you're not using it and get some additional income from it. But if you own the property yourself, you're not re-renting or subleasing, there's just a couple things you want to keep in mind. So we'll just say, like I mentioned before, I have a condo in Arizona. It's a 2-bed, 2-bath, and I had really good luck renting that out. Now, if you are like me, or you have your vacation home, your lake home, a fishing cabin, whatever the case may be, and you use it for personal usage, this is one area you really want to pay attention to in regards to the tax code, maximizing not only your income, but also maximizing your tax savings and the tax benefits you can get through real estate. So I'm just going to go through this as my example. As a short-term rental, we have a condo in Tucson, Arizona. Now, we have our mortgage, insurance, taxes, property management fees, utilities, pretty much the main expenses with that. Oh, and since the condo, got the good old HOA fee. All right, so these are all the expenses. So like with any rental, you're going to have your gross rents minus, all your expenses, like we talked about before. And then gets to your net revenue or net profit. Now, here's the fun part with this. So if you recall from my video, you can search it on my YouTube channel, What is Depreciation? One of the best benefits that real estate owners get through the tax code, perfectly legal, but it's a way that the IRS gives you a blessing to essentially keep more of your own money. So if we look at the gross rents minus the expenses, we have our net profits. I'm just going to throw out a number here. Over a course of a year, we have a net $10,000 in profit. Now, at first glance, you might look at this and how is this taxed? And as probably any accountant's going to tell you, it depends. Is it active income? Is it passive income? Are you materially participating? So on and so forth. What's your marginal tax bracket, et cetera, et cetera. In general, and I'm talking high level here, depending on your particular situation, I would say it is reasonable to assume that probably at least $1,500 of that $10,000 would normally go to taxes, or about 15%. Like I said, everyone's tax situation is different. I'm not a CPA, consult your own CPA, just kind of going over generalities here to get some ideas flowing. So we have our gross rent minus our expenses gives us our net profit. And then what if we owe taxes on it? Well, the nice thing in regards to depreciation, you can check out my previous video on that. Just search for my YouTube channel. Search my YouTube channel, What is Depreciation? Essentially allows you to write off a portion of the building every single year to offset your income and essentially make that income tax-free. No federal income taxes whatsoever. Also, regardless of how this is set up, unless you're a flipper or property management business, typically you're not even going to pay FICA taxes, Social Security and Medicare. Now, there's one particular little carve out in the tax code you'll just want to be aware of and talk to your accountant with, and see how everything fleshes out. The nice thing with depreciation, and again, I'm just going to go in generalities here. let's just say over the course of a year, you have $10,000 net profit after all expenses. Now you've depreciated this property and, oh, I don't know, let's just say, I'm just going to keep this simple. We have a depreciation allowance per year of $15,000. So essentially what depreciation does is it wipes out your net income, and you actually on paper show a $5,000 loss. And I hope this is coming through on the video. Like I mentioned before, this is unscripted. I'm not reading from a script. This is unedited. I have not re-recorded any of my videos. This is just to get the ideas out and content out as fast as I can. So from a tax standpoint, you're going to have $5,000 loss. What does that mean? Well, if you have some additional active income, say you still have a W-2 job or a 1099 job or some other investments, that $5,000 loss can be rolled over and offset some of your income tax from your W-2 job or other investments. Like I said, depreciation is a wonderful, wonderful thing. Now, with short-term rentals and what comes down to personal usage, the IRS doesn't give everything away. What do I mean by that? So back to my condo that I have in Arizona. Now, as of the time of this recording, we've owned it for about 3 years. In the course of all 3 years, we ourselves have not used that condo personally for more than 14 days in a calendar year. Now, if you remember from my previous video this week of how to get started in real estate investing, where the IRS allows you to rent out your home for up to 14 days, and that income is 100% tax-free. The 14 days applies here as well, and I'll quickly walk through it here with you. Now, let's say you have this property. You yourself use that, again, whether it's a vacation home, lake home, your fishing cabin, whatever. You use that 14 days out of the year. And out of that 14 days, you still have your gross rents for when you're not there, minus your expenses, your net profit, yada, yada, yada. And with the depreciation offsets that, you still got the $5,000 carryover. In tax terms, this basically usually comes over as a K1 to offset your other income. And wonderful thing about depreciation. So in this setup, you essentially can stay for free at your own place for 14 days out of the year, which is paid for by your tenant's income. And you get to keep all the income tax-free. And then you still have the depreciation allowance, which then can possibly carry over and offset some of your other income. Now, what if for personal usage, maybe you got to, fast forward several years, I don't know, we become snowboards. I don't know, I'm getting more and more tired of these Minnesota winters, but I don't know, let's just say we stay at the condo 30 days out of a year, which is obviously more than 14. So then at the time of this recording, the tax code is a little bit more picky, shall we say, in regards to depreciation. So you can still use depreciation allowance to offset your income, but you can only use it to a maximum amount of the income you received. So remember when earlier I talked about, just giving an example, if I had $15,000 a year in depreciation allowance, offsets my $10,000 net profit, still have a $5,000 net loss on paper that I can use against my taxable income for my W-2 job or other investments. Since I've used this for personal usage more than 14 days out of the year, this carryover is gone. Still not a bad deal overall. You're still getting nice, benefits of owning real estate, the appreciation, limited depreciation. Your tenants are paying down your mortgage if you have a mortgage, and you can still enjoy it for, whatever amount of time that you want for the year. Like I said, this could be 30 days, this could be 60 days, 90 days, etc. It's just the 14 days. I don't know where the IRS likes 14 days for so many things. But if you utilize your property for 14 days or less in a given year, 14 days or less, then you can utilize all the depreciation. If it is more than 14 days, you stay there, you go down there for the winter, the holidays, fishing, cabining, whatever the case may be. It's more than 14 days, then you're limited to how much depreciable or depreciation you can use to offset the income. So that is, in a nutshell, basically utilizing a property that you own and you are renting it out. I always recommend at least cover your costs, but you have it in a highly desirable area. You keep your expenses in check. HOA fees, utilities are reasonable, and like I said, it's in a highly desirable area with great tenants in place. Can be a great option to get some additional income on a short-term basis. Like I said, the biggest thing with this versus the subleasing that we talked about yesterday, the biggest thing is you're just limited to the amount of depreciation you can use to offset your income. So there we have it, as getting into the short-term rental business with property that you own. With that, be sure to hit that subscribe button, and I'll join you back for way number 10. Take care.